Welcome to The Explainer. Today, we're going to decode the fundamental language of business, and that is accounting. It's this invisible system, right? It's behind everything from your local startup to a massive global corporation. And today, we're pulling back the curtain to see exactly how it all works.
Okay, so let's just start with a really big question. How does a global corporation, or heck, even a small coffee shop, track every single penny that comes in and goes out without it all just turning into total chaos? I mean, think about the sheer volume of transactions. How do they possibly keep it all straight? Well, the answer might actually surprise you.
Believe it or not, it all comes down to one really elegant 500-year-old idea. Yeah, you heard that right, 500 years. It's not some fancy new app or complicated software. It's this beautiful, simple concept, the rule of balance.
So let's really dig into this thing, this billion-dollar balancing act. It's all about something called the double entry system. And I promise you, once you get your head around this, the whole world of business and finance is going to start to click.
So this whole system is over 500 years old. It was first written down by an Italian mathematician named Luca Pacioli. And it's built on a really simple but profound truth. Every single transaction has two sides. You can't just look at one part of the story. You got to record both to see what's really going on.
It's kind of like that law of physics, right? For every action, there's an equal and opposite reaction. Well, in business, for every transaction, at least two accounts are affected. Money doesn't just poof into existence or vanish into thin air. Every time a business does something, buys a laptop, sells a coffee, takes out a loan, it creates a ripple that touches at least two different places in its books.
And this whole idea, this entire system of balance, is all wrapped up in one beautiful 500-year-old equation. Seriously, this thing is like the master key. If you understand this equation, you can unlock the financial health of pretty much any company.
So here it is, the accounting equation. And this is the heart of it all. It's the central pillar that everything, and I mean everything in accounting, is built on. It basically shows that what a business owns has to be equal to what it owes, either to others or to its owners. And this equation, it has to balance, always, no exceptions.
Assets equals liabilities plus equity. Looks simple, right? But it's so powerful. On the left, you've got assets. That's all the stuff the business owns. Think cash, computers, buildings. And on the right, you've got the claims against that stuff. Liabilities are what the business owes to outsiders, like a bank loan. Equity is what it owes to its owners. And those two sides, they have to be equal. They must balance.
All right, talk is cheap. Let's see how this thing actually works. We're going to build a really simple business from scratch. Let's say a freelance web developer. So right at the beginning, before anything happens, everything is zero. Assets are zero, liabilities are zero, equity is zero. The equation is in perfect balance.
Okay, transaction number 1. The owner decides to start the business by putting in $5,000 of their own money. So what happens? Well, the business now has an asset, $5,000 in cash. But to keep the equation balanced, the other side has to go up too, and that's the equity, the owner's claim on the business. So, assets go up, equity goes up. See? Perfectly balanced.
Now, what happens when they buy a tool for the business? Let's say a $1,200 laptop, paid for with cash. Now, this is interesting. The change here happens entirely on the left side, the asset side. The cash asset goes down by $1,200, but a new asset, equipment, goes up by $1,200. We've just swapped one asset for another. The total on the left side is still $5,000. The balance is perfect.
And for our last example, let's say the business needs a little more cash, so it takes out a $1,000 loan from a bank. So what happens? Well, cash, an asset, goes up by $1,000. But now the business owes someone money, right? That's a liability. So liabilities also go up by $1,000. And look at that. The equation is still perfectly, beautifully balanced.
All right, so now we get the idea of balance. But what's the actual language accountants use to make this all happen? We're about to get into debits and credits, and I need you to do me a favor. Forget everything you think you know about the word credit from your credit card bill. This is a whole different ballgame.
This is probably the most important thing to get straight. The words debit and credit do not mean good or bad. They don't mean plus or minus. They are totally neutral. They are just directions. That's it. They just tell you which side of an account you're putting a number on.
Seriously, it's this simple. Debit just means left, that's all. Credit
just means right. The entire practice of accounting is just about figuring out whether a number goes on the left side or the right side of an account to keep that big equation in balance. Left and right. That's the secret.
Okay, so how does it work? Well, here are the golden rules. If you want to increase an asset, like cash, you debit it. You put the number on the left. But, and this is the magic part, if you want to increase a liability or equity, you do the opposite. You credit it. You put the number on the right. See how that works? It's these opposite rules that act like an engine, constantly forcing the whole system to stay in balance.
So great, we've got our concept of balance and we've got our language, debits and credits. But where do we actually write this stuff down? Well, that brings us to the journal.
The journal is basically the business's financial diary. It's the book of original entry, meaning it's the very first place a transaction gets recorded. And it's not organized by category, it's chronological. It's just a running story, day by day, of every single financial thing that happens.
So remember our first transaction, the owner putting in $5,000? This is what it looks like as a formal journal entry. You can see we debit the cash account, an entry on the left, to show that asset went up, and we credit the capital account, an entry on the right, to show the owner's claim went up. Debit on the left, credit on the right. It's balanced, right there in the entry.
So let's just quickly recap the key takeaways here. At its core, this whole 500-year-old system is about one thing: balance. The accounting equation, assets equals liabilities plus equity, is the unbreakable rule of that balance. Debit just means left, credit just means right. And we use those rules to write the financial story of a business, day by day, in the journal.
And here's the thing. Now that you know the language of business, what story will your numbers tell? Because understanding this stuff doesn't just help you, run a business. It gives you the key to read the story of any company in the world. It's the universal language of how money moves, and now you speak it.